Even though the stock market, as measured by the S&P 500, looks fully valued to overvalued today, here are a baker's dozen, 13 consumer staple stocks that look attractively valued. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. This is part 2 of my 11-part series on covering various sectors. I'm covering the consumer staple sectors today. Now, I want to make a point because I've had comments and, what I consider to be people who really haven't watched the videos or understood what I'm doing here. I'm not necessarily recommending these stocks. What I'm doing is I'm pointing out by using a screen stocks in each sector that appear to be fully valued that can serve as research candidates if any of them strike your fancy. But I'm going to let you decide that, whether or not you like these stocks or not. And as always, I'm going to utilize the FastGraphs Fundamentals Analyzer software tool to illustrate what these 13 companies look like and what their valuations look like as compared to the overall stock market. The first fast graph I'm going to show today is, of course, the S&P 500. And I just want to orient people who aren't used to looking at a fast graph as to what this chart does. So I'm going to take it apart first. We plot the earnings per share. That's the orange line on the graph. All right, and then we calculate a growth rate, and it's S&P, going back to the beginning of 2002, grew earnings by 7.89%, including estimates. Now, we then bring in weekly closing stock prices to show this is a theoretical fair value reference line. Then we add a blue line, which is called the normal PE. This is the valuation that the market has most commonly applied over whatever time frame's being drawn. And then, of course, we bring price in, weekly closing stock prices, to illustrate how price correlates to and tracks the company's operating results. In this case, we're using earnings. Now, FastGraphs also gives you the opportunity to use, I'm using operating earnings. You can use diluted or GAAP earnings, cash flows, EBITDA, sales, etc. But I'm going to stick with earnings for simplicity in this video. Once I put the weekly closing stock prices, you can see how important this blue and this orange line is, especially in this case, the blue line. The market over this time frame, going back to 2002, the beginning of 2002, has tracked earnings at about 18.5 times earnings on average. That's the multiple of this blue line. Anywhere the stock price is touching that blue line, it's trading at that 18.5 times earnings. And here's, real close. And you can see that's been a very good valuation reference for the S&P. Now, starting in 2010, for the next 2 or 3 years, this 15 PE ratio, which is the valuation of the multiple of the orange line, was very, very relevant. And that stuck till we came to the end of 2013. Then the market went back to its normal valuation. Then it got overvalued, finishing up in 2021. And then, of course, we had this correction, and it's now trading within range of that normal valuation. The current blended PE is 20. Now, I like to see a 15 PE, which also, I believe, it also includes a margin of safety. That would even include the S&P 500 ETF Trust. I would be interested in buying it at 15, but I don't like to buy it at these higher multiples. All right, now I was also requested by subscribers to the channel to also contrast, by looking at some overvalued stocks. So I'm going to show you 4 overvalued consumer staple companies before I show you the 13 that I screened for. And those 4 are really well-known companies. This is Church & Dwight, best known for Arm & Hammer baking soda. And again, I want you to see you have the orange line, which is the theoretical fair value with a margin of safety. We have the blue line, which is how the market has typically valued it. And we can see right now that it's trading even above that blue line. And, when it's done that, you can see that from peak to peak here, the rate of return was very abysmal, you might even say, over the last 3 years. Valuation matters, and it matters a lot. Now, had you bought this stock when it was trading at that, roughly at that 15 PE, here's one that's pretty good at 17 PE. My annualized rate of return is almost 15%, and that's inconsistent with the company's 12% growth rate plus a dividend yield that has increased every year. I want you to notice the dividend has increased every year. But the problem is the S&P looks overvalued and Church & Dwight looks overvalued, and we haven't had a lot happening in the last couple of years except a lot of volatility. The next stock that I would consider overvalued would be Clorox. And you could see Clorox had a very consistent growth rate during this period of time up through 2020. And they have a June fiscal year. So that was up through June of 2020. And you can see, again, a 20 multiple. The market put a quality premium on this stock. It did get down into the, close to the 15 multiple or cheaper, but then it got very, very overpriced, but it had a very nice, consistent 7% earnings growth rate. But then earnings faltered in 2022, 2021, 2022. They recovered in 2023, faltered again, expected to falter again this year and begin recovering again. But this high valuation that we saw here where the PE was over 30, August of 2020, culminated in a very dismal, 11.97% annual loss. That turned $10,000 into $5,895. Valuation matters, and it matters a lot. And then last but not least would be Colgate. And Colgate has always commanded a premium. It's a AA rated stock. It does have a lot of debt, but you can see that it's traded at around a 20-ish multiple. 22.28 is the precise calculation. But even at that high multiple, when it peaked here at this high multiple, with relatively flat growth, there was very little growth in Colgate. You can see that the stock has only generated a 3.38% rate of return, and that includes dividends. Capital appreciation was only $1,354 over this, 7-year period or 8-year period, whatever this is. So valuation matters, and it matters a lot. Colgate was a great company here, but it was so fully valued, it was very difficult for investors to make any money. But anyway, let's go into our screen now, and let's look at what I screened for. First of all, I screened for the consumer staples sector, and I just wanted all primary companies. I screened for dividend yields of over 2% for the income stocks, and for the total return stocks, which this is the total return portfolio, there were a couple that didn't pay any dividend or were lower than the 2% dividend yield. So I had 7 stocks in the income, and I just combined them here for sake of simplicity. All 7 of those are included in this list, and they're the ones with the dividend yields above 2%. So we can, go into the dividend yield column here, and you can see that those 7 companies were Coca-Cola European, Campbell Soup, Smucker, General Mills, Conagra, Philip Morris, and Altria, or the original Philip Morris, I like to say. But these are the 7 companies, and I'm going to do them in alphabetic order like I usually do, and I'm going to talk about. So what I screened for was GICS sector consumer staples, dividend yields of above 2% for the income stocks, and just value PEs 16 or below. I looked for earnings yield over 6%. I prefer 6.5%. I liked relatively persistent earnings, meaning that there wasn't a lot of volatility in earnings, some, but 100% would be perfect, and that would be Altria. And then I looked for, I want total rates of return that were positive and earnings growth that was positive. Okay, and I also looked for estimated compound annual growth rate going forward that was positive. And that gave me these 11 names. Now, this isn't all the consumer staples that I think are attractive, but these are the ones that met my screen and met my screening criteria. So we're going to go through them one at a time. And I want to point out some things about these stocks as I go through this. First of all, let's look at Conagra here. And Conagra engages in the manufacture and sale of processed and packaged foods. It operates through grocery and snacks, refrigerated, frozen, international, and food service. The snack segment includes branded, shelf-stable food products sold in various retail channels. The refrigerated segment is composed of branded, temperature-controlled food products. The international segment offers branded food products in various temperature states sold in various retail and food service channels outside the U.S., and the food service segment focuses on branded and customized food products, including meals, entrees, etc. It was founded by Elva Kinney and Frank Little in 1919 and is headquartered in Chicago, Illinois. Okay, but now looking at Conagra from an investment perspective, I want you to note a couple of things. This is a very high-quality company. It's BBB- rated, has less than 50% debt to capital. It currently offers a dividend yield of 4.7%, a very attractive earnings yield of 9%, and a blended PE of 10.8. But I want you to note, even though there's been a little bit of cyclicality in the earnings have only grown at 2.7% over this roughly 20-some year period that I'm showing here. Now, using the Graham-Dodd formula that Ben Graham, we then created a fair value reference of 13.9. That's the orange line on the graph. So anywhere that I would be touching the orange line on this graph, it would be a PE ratio of 13.9, or we'll call it 14. The 13.46 was how the market has valued it, which means the market has generally valued it more or less consistently with what the fair value formula that Ben Graham developed would indicate. Now, again, we have very low growth, somewhat cyclical. Coming into the Great Recession, we saw that the stock fell down to a PE of 6.7. Interestingly enough, even at today's low valuation, if you'd have bought it at that very, at the most attractive value, you'd average over 9%. But I also want to make it clear that even if you bought it when it was in line at around a 13 PE, you'd have earned 5%, which was a little more than their earnings growth, but plus dividends. All right, so Conagra has not necessarily been a great long-term investment, but it's been a very stable one, and it does offer a very good dividend yield. And the dividend was cut coming into the Great Recession, but since then, the dividend has actually grown rather consistently, except for the 3 years in 2014, 15, and 16. They maintained it. Then they raised it by a penny and then increased it again. But the point is, it's got pretty steady income, and you can currently buy it at a yield approaching 5%. Now, looking at it going forward, if I go into the forecasting calculators, the company is expected to grow more or less like it always has, but because the PE ratio could theoretically rise up to 14, or I'll use the 12.7, that's below their normal, valuation. That would mean if you bought it today because of the margin of safety, you could end up generating almost a 14% annualized rate of return out to 2026. This is not about growth. It's about a relatively attractive dividend yield and the PE ratio expanding from 10.8 to my example here to 12.7. If I put the PE a little higher at the 14.1, you could earn over 18%. So valuation can turn a relatively conservative, stable, but low growth company into a reasonably high return investment if you buy it cheap. Now you can see it's already starting to recover off of its lows, but this is Conagra, the first in the group. The second one would be Coca-Cola Europacific Partners, and this is a very interesting company. It's had average growth has been 6.78%. This company has consistently traded between 15 and 16 times earnings. The blue line is 16.2 times earnings. The orange line is 15, and you can see that that's a very, very predictable earnings reference, if you will. When it gets above that, it was a less than optimum time to buy the stock where you could actually have some losses. But when you bought the stock at the attractive valuation, it moved back to attractive valuation, you could make double-digit rates of return. The company has also paid a very high $10 special dividend in 2010 and a very high, it looks like a $13 or $14 dividend, special dividend in 2016. So if I look at performance here, you can see that the special dividends really increased the income level of this company over time. So a $10,000 investment, back on January 3rd, 2003, and held till yesterday's close would have thrown off over $33,000 in income. But that's really the result of two very special dividends that, increased the yield, just significantly over this period of time. There's the $10 dividend that we see. And then in 2016, there's the $14.50 dividend. But those two dividends really created a lot of, dividend income. Now, the average growth is kind of an anomaly because of those special dividends. But the compound growth of dividends has been 12.54. But that is a little bit exaggerated because of those special dividends, just to be sure. But bottom line is this has been a very, very steady performer. If I take the dividend income off of here, you can see that the growth of the company, it's been somewhat a little cyclical, but you can see how closely stock price has tracked it, over time. Looking at the future, this company is expected to continue growing at about 8%. That makes it an attractive investment with a 15 PE of about an 8% total rate of return. Again, not a whole bunch of growth, though. Here we have a little bit of PE expansion. If I use the normal multiple, of, in this case, the 5-year normal multiple has been 17, that would give me a 14.7. So this looks like an attractive time to buy this company if you were attracted to it based on its long record of dividend payments and its income level. The next company is Campbell Soup. Campbell Soup is another what I would call relatively slow grower, 3.5%, some cyclicality. The market tends to put a premium valuation on this stock from time to time. It currently got very inexpensive, in October of this year, and it's now, recovered a little bit. But you can buy it at a 14.44 PE, a 6.9% earnings yield, a dividend yield of 3.38%. And if I look at it going forward, it's expected to grow at 5%. That would give me just under a 10% total rate of return if earnings grew at 5.1% and it traded at a 15 multiple. The normal multiple has been 15.6. That would raise it up to about 11.52%. But if you were going to invest in Campbell Soup for the income, for the higher yield, this would be an attractive entry point if Campbell Soup, if you like that kind of company. Here's Empire Company Limited. This is a Canadian company. If I go into the company's website here and look at what this company does, I'm not real familiar with this company. Let's talk about what the company does. It's Sobeys. I'm not really sure what this is. It's a Canadian company headquartered in Nova Scotia. Their business is food retailing through wholly owned subsidiary, Sobeys, and related real estate. So I guess it's a grocery chain. Now, it did have some earnings issues in 16 and 17. They have a fiscal year in April. You can see the company has recovered since then. It looks, very attractive. Currently is expected to grow at 8.78%. And I'll go as far out as I have dividend estimates. That could be a 25% annual rate of return for the next couple of years if it grew earnings as expected and traded at a 15 PE ratio. Historically, it's traded at about a 14 PE ratio. So I think it's also worth looking at that and recognize, now here the last 5 years it's been at a premium PE. But if I go and find this 14 PE ratio, then, if the stock only traded at a 14 PE ratio, it would, be able to generate almost 15%. So, over 20% at the 15 PE ratio level, if you're looking at the place where there's dividends, and still double digit even if you look at the normal PE. So that's Empire Company Limited. The next is General Mills. General Mills has, been about a 15 to 17 multiple company historically. The best time to buy it is when it got really inexpensive. The PE got down to 15. It came from, it fell dramatically with, earnings growth is expected to be around 5% for the next couple of years, including this year. It has a May fiscal year, so May 2024 will be the end of their fiscal year. You can see it's been a very, very consistent grower. It has moderate debt, a 3.57% dividend yield. And if I look at the long-term performance of this company, you can see that it slightly underperformed the S&P 500 on total return, but it dramatically outperformed it in income. And this is what I've even had the question, should I own a dividend-paying stock that, doesn't beat the market? Well, I want to remind you, the market is overvalued right now, so there's a premium valuation on the market. I don't think the market's real rate of return will be that good in if you add in a couple of more years going forward, where we'll get some corrections in valuation. This one is undervalued and still posted a pretty decent rate of return as far as growth return. But the dividend was $17,700 versus $9,100 in the S&P. So this is clearly a vehicle, a consistent, high-quality vehicle that you would invest in for the income, and this would be the attractive time to do that. Herbalife is kind of a more speculative company. They did pay a dividend. They eliminated their dividend. Company has been very volatile from an earnings point of view recently, and that, of course, led to stock price volatility. What's interesting is that the stock currently trades at less than 6 times earnings. Earnings recovery is expected to be very strong over the next couple of years, and this would indicate a very, very high rate of return, but I would call it speculative. It's only a B-plus rated company. It does have over 150% debt to capital, but the PE is low. The earnings yield is 16.86. So this would be a consumer staples company that was, basically a turnaround situation and a speculation is what I would recommend anyone interested in Herbalife to be thinking of. They think of this as a very speculative investment. The next stock we want to look at is Loblaw Companies Limited. This is another Canadian company. It's food retail again. And you can see it's had, a little bit of a cyclical record. It's probably a little fully priced right now for my taste. I'd like to see it at 15 times earnings or below, like it was here. It's gotten a little bit, pricey now, but the rate of return out here, could be, 6 or 7% going forward. Long-term growth is not available, so I don't have an estimate, but it has a decent dividend record. They've maintained their dividend. I wouldn't call this a dividend grower, but since 2011, it has been consistently growing its dividend. So if I shorten this time frame here and get it into 2011-ish and then look at performance, the dividend growth has been about 8% a year since, it started paying a dividend or started growing their dividend more consistently. I'd say it's a little pricey, but it's one you might want to watch if the stock, happens to falter a little bit from here. Altria, the old Philip Morris, is the one with the best earnings persistence score. You can see without price being involved in this how just consistent this company has grown at about 7 or 8% a year. The market has typically priced it between 14 and 15 times earnings, and that was until 2018. And since then, it's been trading at a much lower valuation. It offers earnings yield of almost 12%, a dividend yield of over 9.5%. It does have a lot of debt, but it does have a BBB credit rating, which indicates that it's probably capable of handling the debt. This would be one purely for income. I think if you look at operating cash flow, they generally cover their debt. And then if you looked at free cash flow, they generally cover their debt. So this is one that I think is purely an income investment. However, because of the extremely low valuation, this could also generate substantial annualized rate of return of over 45% a year for the next couple of years if it were to move back to a 15 PE ratio. The normal multiple for these years has only been 11. That would still give you a 27% annualized rate of return going out to the end of December 2025. So this stock looks very, very attractive for the income investors with a total return kicker because of its low valuation. In other words, we'd be expecting PE expansion of almost doubling from 8.3 to 15, or actually to only 11. If it doubled to the 15 number like I was talking about, then this could be generating 45% annualized. It could more than double over the next couple of years if it earned what the analysts expect and if it returned to a 15 PE. I believe it eventually will, but that's my view. Okay, here's Metro Inc. This is another food retailer, a Canadian food retailer. You can see how closely its price has tracked earnings. Last decade or so, it's been trading at a relatively high PE, but it does have good earnings growth at around 9. The forecast is for a 6% growth going forward at a 15 multiple. That would give you a 4% rate of return, including dividends, because we'd be looking at some PE ratio contraction. The normal multiple in this company, however, has been higher for the last 5 years at about 18. And I want you to clearly see that when I look at this graph. You can see that when I look at historically, this company has traded 15 times earnings or below. But if I shorten the time frame, now all of a sudden we see that PE ratio has blown up to about 18 times earnings. This is 17.58 is the blue line here. Chop another, and we're getting really right at 18 times earnings. So looking at the forecasting, the normal multiple for the last 5 years has been 18. If it did earn as expected and traded at that, it could give you a 15% number, but that would be trading at a premium valuation in my opinion. The next stock is Nomad Foods. This is a non-dividend payer. It is expected to start paying a dividend. It's a reasonably attractive stock based on the fact that the valuation is trading below a 10 PE. It has over a 10% earnings yield. It has modest debt at 44%. And looking at forecasts growing forward, expected to grow at 9.5%. This would be a pure capital gain play. Even looking at their normal multiple of 14 times earnings, this could generate over 30%. But again, this is strictly a total return investment, looking for capital appreciation almost exclusively in this stock. Philip Morris International is the spinoff from MO or Altria, and it's been about a 4.5% grower. It's trading at a reasonable valuation today. The PE is just above 15 and offers a 6.5% earnings yield and a dividend yield of 5.59. If I look at long-term performance here, the dividend growth has been averaged over somewhere around 8 or 9%, but I do want you to note it's slowed down tremendously of late for the last 4 years. And that would be expected because if I shorten this time frame here, we can see that the growth rate of earnings has slowed down, we'll call it 5%. And we have a 0% growth and a negative percent growth. But then we also have some, spotty expectations. As you can see, looking at the max chart here, this company is what I would call a quasi-cyclical. It has periods of good growth followed by some modest dropouts, has a very, very high payout ratio. But again, as an income vehicle, it has cash flows that cover the dividend very nicely. So I think Philip Morris looks attractive at these levels for primarily as an income investment with some capital kicker. Smucker's, looking at it from an earnings perspective, like I have most of these companies, it did pay a special dividend back in April of 2009, or in 2009. It has an April fiscal year. It's had very good growth. It was overvalued or fully valued. It's gotten inexpensive. You can see the stock price is moving back to the normal 15 PE. If that were to occur at the end of 2026, you could average over 16% a year, including dividend income. The normal multiple would be just below 15. That would still be a 15.5. So, that's been a consistent stock between the 15 and 16 multiple or higher over time. So Smucker looks attractive today. It would be a good time to be investing in it. Next stock on the list is Weston George Ltd. It's another Canadian company trading at a 15 multiple. It did pay a special dividend in 2011, although it went through several years of negative growth, but it was still a profitable company. I want to make that clear. Just because it had negative growth, it was still profitable. But now if I shorten the time frame, actually I'll shorten it one more year. Since the beginning of 2013, January of 2013, it's grown earnings at almost 9% a year. It's forecast to grow earnings at over 12% going forward. So this one looks very, very attractive for growth, with a 13% growth. Modest dividend yield under 2%. So there you have it. These are the baker's dozen, I call it, the 13 consumer staple stocks that look attractively valued now. 2 or 3 of them have total return or good growth potential. The rest of them have, primarily they're good income vehicles. Part of what this video is all about is understanding the nature of the beast. You can see that consumer staples don't grow necessarily very fast. Okay, and that's something you should always take into consideration. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, presenting part 2 of my 11-part series covering the various sectors in the market to try to give you some perspective of what you can expect from these different sectors. It's not that I'm recommending any of these sectors or even any of the stocks I've covered. I just want to give you a good, clear view of the market. As I always say, it's a market of stocks, not a stock market. If you like the video, give me a like, subscribe to the channel, and take a look at FastGraphs. And by the way, we got some very exciting new features we're going to be adding to the Fundamental Analyzer software tool. Thanks for watching. I'll talk to you guys again real soon.